Okay, so the purpose of this lecture is to quickly give you a summary of lessee accounting in terms of IFRS 16. Okay, so this is a one-page summary to just give you a quick overview of the important concepts here. So when you deal with the lessee, so this is the party that gets the underlying asset of the lease to lease it for a certain period of time, and this lessee will then make payments to the lessor for the use of this underlying asset. Okay, so what will happen here is that in terms of IFRS 16, the lessee will now recognize a right of use asset in the statement of financial position and a lease liability in the statement of financial position. So how would that look in a journal? On initial recognition of the lease, the lessee would do the following journal: debit your right of use asset in your statement of financial position, and then credit your lease liability. So you will have these two elements in your statement of financial position. Now let's look at the measurement of these two elements. So the right of use asset, the initial measurement. So the cost of the right of use asset will comprise of the lease liability. So the measurement of the lease liability on commencement date. You will include any direct cost, any prepayments, so payments be made on or before the commencement date of the lease, and from that you will deduct any lease incentives. Also, what should be here is any estimated costs of dismantling or removing or repairing the asset should be included here. So any provisions that you raise for such a cost in terms of IAS 37 will also form part of the cost of the right of use asset. Then subsequently, how would you measure it? Well, you will depreciate this asset. Watch out that here you have to look at what happens with the ownership of the asset at the end of the lease term. If the ownership of the asset passes to the lessee, then you use the useful life to calculate the depreciation. If the ownership does not pass to the lessee at the end of the lease term, then you have to use the shorter of the lease term or the useful life. Okay, and that will be the amount that you will use to determine the depreciation. Watch out that your right of use asset can be revalued. So it is by default in the cost model, but it can be revalued if it forms part of the class of assets in property, plant and equipment that is revalued in terms of the company's accounting policy. Also, if this right of use asset is part of an investment property that is fair valued, then you are allowed to also fair value the right of use asset. Good, and disclosure. So what will you present or what would you disclose for this right of use asset? You will do a reconciliation of the opening and closing carrying amounts of the right of use asset. You have to separately also disclose the depreciation on the right of use asset. Okay, then you have to deal with your lease liability, the initial measurement of this lease liability. So at commencement date of the lease, that amount is determined as the present value of all your lease payments, including your guaranteed residual value. Okay, so you're going to present value all your lease payments and also any guaranteed residual values at the end. What rate should you use? Okay, well, always first price is using the interest rate implicit in the lease. If that cannot be determined, you are allowed to use the incremental borrowing rate of the lessee as a discount rate. Okay, subsequently, how would you measure a lease liability? Remember, this is a finance liability in terms of IFRS 9. Therefore, you will measured at amortized cost. Just watch out for any remeasurements of the lease. When a lease liability is remeasured because you've either changed the lease term or something like that, it will result in a change of the carrying amount of the lease liability. So watch out for any of those for subsequent measurement purposes. Then when it comes to disclosure of the lease liability, you have to do a maturity analysis. That is very simply just showing all the remaining lease payments per year. It's an undiscounted amount, so it's quite easy to do. And then remember that the finance cost on the lease liability has to be separately disclosed in terms of IS1. Now, having said all of this, IFRS 16 allows the lessee to elect a simplified accounting for the lease, and that is for all short-term leases less than 12 months, or when you have low-value assets below $5,000, you are allowed to ignore all of this, the right of use asset and the lease liability. You don't have to recognize it. You can merely straight line all your lease payments, show it as a lease expense in your profit and loss. And that is a quick and nice summary of your lessee accounting in terms of IFRS 16.